I don't think this cycle's over until rates go negative everywhere. There is an inherent belief in investors that the US cannot go negative. It's the world reserve currency. How can the US rates go negative? And something you and I have talked about many times is that it's not up to the central bank. It's up to the market. And at some point, and I'm looking at the 2-year rates now, there's a beautiful flat line at about 10 basis points.
Right.
Right, we're currently at 13.5 basis points. So 3.5 basis points lower, 4 basis points lower, we've broken the support line. Next stop, 0, and probably negative. So, okay, so what is the probability of that? We go back to this COVID slowdown. If this continues, and let's say the equity market sells off a bit and the reflation trade comes off, all rates are going to 0. And then people will start flattening the curve because they'll go out the curve. Now, what's really interesting is if you remember we were talking about how short everybody was the dollar, well, they're even short of the bond market. Record shorts in 30-year bonds. They've just turned short net negative on 10-year bonds. The market doesn't believe that this could possibly not be reflation. And if they're wrong, there's a bloodbath to come from the shorts in the bond market. And capital has to find somewhere to go. It's probably very bullish for emerging markets because capital will find a return. And in that environment, there's no return in G10, but there's return in many other places. You know, if we go into a different world, as if by magic, and we're now in India trading macro, I look at my screen, Indian rates are at 6%. In 2 years, 4.5%. Okay, well, that's a different world to start with. Oh, guess what? The population is 32 years old. Okay, well, that's very different. You know, so there is an alternative universe that doesn't look anything like this. But investors are so used to this US G10 bias. It's going to take a while for them to get used to it. So that's my death of macro, is that the opportunities that come out of macro trading tend to be more cyclical as opposed to secular, and the secular trend shift goes elsewhere. We're in a risky window now. The window is Europe shut down. We've just seen, I think, Toronto get shut down, peak virus, a slowdown, Biden about to come in, the probability of more restrictions across the US rising. We've also just got through all of this option gamma that's rolled off because it's option expiring. That was keeping the market up. So it's kind of, we're now at that period where things can change. We also talked about, okay, the dollar was massively oversold. So, and it had the largest speculative positions short the dollar in history. So that's starting to get unwound. We've seen the equity market, which is a huge speculative excess right now, for whatever reasons people want to talk about. And all of this stuff starting to feel like it's going to come unwound. And it's something we've all been expecting, and it's not something I've been trading. I've been long the bond market, which we'll come on to in a bit as well. And even crypto's getting shaken out today in a very, very volatile Friday. I'm not sure that this is not a sign of a larger corrective move. Retail sales today as well, pretty terrible numbers. I know it's unfashionable to be a macro bear, but when you see $1 trillion of penny stocks trading in a month, that's never happened in history, nothing close. It tells you the speculative excess. We've seen individual option trades, all-time record highs. You know, pretty much every measure has shown speculative excess that hasn't been around since 2000 or 99. So you got to take it seriously. I mean, does it mean that we're about to have a massive bear market? No. Could it? For sure. I mean, this is not a market for widows and orphans, I think. I think you just have to be careful.